Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.
In this lesson, we will examine how to calculate the earned income limit. The amount of work-related expenses used by a taxpayer to figure the child and dependent care credit cannot be more than either the taxpayer's earned income for the year, if he or she is single at the end of the year, or the smaller of the taxpayer's and the taxpayer's spouse's earned income for the year, if he or she is married at the end of the year. If the taxpayer is either legally separated or married and living apart from his or her spouse, the taxpayer is not considered married for the purposes of determining the earned income limit. Special rules also apply to taxpayers who are widowed during the year and file a joint return as a surviving spouse. Those who are members of the clergy or are church employees, statutory employees, and self-employed individuals who have low earnings or a net loss during the tax year. Now let's take a look at review question number 15. Mary and Joe are the parents of 3-year-old Molly. They paid child care expenses of $2,400 for Molly last year. Mary's earned income for the year was $26,000. Joe's earned income for the year was $2,200. The amount of expenses Mary and Joe used to calculate their work-related child care expenses credit cannot be more than A. $2,400 because Mary's earned income qualifies her to claim the credit, B. $3,000 because that is the maximum credit allowed regardless of earned income, C. $2,200 because the amount of their credit cannot exceed the smaller of Mary and Joe's earned incomes, or D. $1,100 because the amount of their credit cannot exceed 50% of the smaller of Mary and Joe's earned incomes. The answer is C. The amount of Mary and Joe's credit cannot exceed the smaller of their earned incomes for the year.
Like what you see? Get unlimited access to all of our CPE courses at www.teachucomp.com/unlimited CPE.